Hey everybody, Chuck Barone. Friday, December the 2nd, 2022. Let's close out this week. We have a lot of interesting stuff today. We're getting a little bit of an idea of where things are going, I think. But as always, before we start the show, we want to welcome everybody, let you know how much we appreciate your support for the show, watching the videos, and all the things you guys do every day to keep us going here, to want to make these shows for you guys every day. Much appreciated. The markets today, I think today was kind of just let's take a breather and kind of get the lay of the land day. And everything basically today was either flat or up or down small. The markets today were mixed, basically flat. Not a lot of action in the market today, one way or the other. The market started out down. The jobs report shocking everybody. Rallied up, actually were in positive territory before falling back down. The Dow eking out a gain. S&P, NASDAQ down. But like I said, marginal numbers. I think that, again, like so much mixed data to digest. I think the market just needed a breather, and we got it today. Same thing with the bond market, basically flat today. Not a lot of action either way. The 10-year landing at 3.50. Can't even read my own writing. Down 2 basis points. The 2-year, by contrast, still inverted, 4.28%. So now you got a 78 basis point inversion. That the 2-year basically flat today, no change in the yield. Bond market still in bear status, still inverted, still signaling big recession to come. They say that the wider the inversion, the worse the recession's going to be. So we'll see. We'll see. This bond market is certainly indicating some stormy seas coming. The dollar today down very small, sitting at 104.5 on the index. Still a good strong number for the dollar. Nowhere near where it was at its peak at 114, but now falling back down to earth. A more normal number, which, you know, when the dollar was so high, it was driving everybody crazy because it was creating all kind of trade imbalances and hurting dollar-denominated debt around the world, making poorer countries were having difficulty as they converted their currencies into more expensive dollars. Long story there, but the dollar, I think, in a good place right now. Probably still ways to come down, though. Metals, down small today. Gold down after a nice rally yesterday. Gold down $5.70, $1,798. Silver up 34 cents today, $23.09. Nice price for silver. Silver looking like it's pretty strong right now. Metals, again, like I've been saying pretty much every day on the report, holding their own. I think they really want to rally. We're getting to some nice levels here with 1,800 for gold and 23 for silver. I still think we got room to the upside as this dollar continues to decline. Oil today, not much happening. $80.34 for a barrel of West Texas. Natural gas, again, doing its crazy gyrations, down 7% today, $6.22 for their million BTUs. I don't know who's trading that option, but it must be a circus every day. Can you imagine 7, 8, 10-point swings up and down every day? And I guess if you're a trader, that's wonderful stuff. But if you're an investor, that's no way to live. And to wrap up the market stuff today, Bitcoin up very small, $90. The good news for Bitcoin, though, is it got back above the resistance at 17,000. That number now becomes support. Let's see how long Bitcoin can hold that support if it continues to make any gains. News you guys need to know today. Big news. Jobs, 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 guys. The job market continuing to just sizzle, sizzle, sizzle. They were expecting 200,000 jobs added. We added 263,000, a big shock to the market, kind of a setback to the Fed, because although it seems like prices are coming down, now I shouldn't say coming down, that's not right. Prices aren't going up as rapidly as they were. But a hot job market, and not only the hot job market, but you combine it with wages. Wages up 5.1% this year versus 4.6 expected. So what's happening is, and I went into a little more depth with this a couple of times in previous videos. The big worry the Fed has is this wage price spiral. Okay? Now, to break it down into super simple stuff, what happens is inflation causes prices to rise, which we have all seen, making people unhappy because they can't afford the regular stuff they bought that was affordable no longer is. So they go to their boss, they demand more money, they start looking for jobs, they start changing jobs. So bosses want to keep their good employees, they pay them more money. But at the same time, because their payroll's going up, they tend to not just swallow that expense themselves, they raise their prices. Well, now you start what they call the wage price spiral, where prices are up, we need higher wages. They do it, but then they raise their prices, and now you're in the same situation. Prices are up, we need higher wages, and it just goes step by step. And once you get stuck in this trap, that was the big problem they had back in the 70s into the 80s, a big part of it. We're getting into this trap now, and it's just another signal that what I've been saying is probably the most likely scenario. Rates are going to go higher than people expect, and they're going to stay higher for longer than people expect. Now, here's the good news. If you take that advice and you prepare yourself for that by getting yourself into a defensive position in your portfolio, by trimming debt if you possibly can, by not adding on any additional debt, again, if you possibly can, by being thoughtful about the way you spend your money, trying to be less impulsive and less, stuff that's with discretionary, right? Be thoughtful about those expenses. If you have an option to save or spend, my advice is stash some, even if it's not all of it, just stash a part of it. Start to develop these good habits. They will serve you well. Now, here's the good news. If we're wrong, and they start cutting rates and everything just goes kaboom, and starts flying again, real estate, stock market, everything else, well, you might give up a small portion of gains, but you're certainly going to be much more well protected from any losses if we're right, which in my opinion, humbly, is way more likely. So we have a really interesting scenario here with the jobs market defying the Fed, businesses continuing to hire, wages continuing to rise. In the face of so much doom and gloom and other mixed data showing basic recessionary stuff, looming layoffs, big tech layoffs. We've been hearing about that nonstop, and still employment's super robust. The unemployment rate unchanged, 3.7%. I don't know, guys. I'm going to have to do a little bit more analysis on all of this, because I'm starting to make up my mind right now that this phantom recession that got signaled by 2 negative quarters at the beginning of this year is really just that, a phantom. I think it's more of rather than recession, it's particularly the only industries that are really suffering the most. I guess everybody is. We're in a bear market and business isn't so great, especially if you're in real estate, but it's this interest rate sensitive industries, just like real estate and mortgage. Speaking of that, to pivot to the next item on the list, well, I was talking yesterday about Blackstone, not BlackRock, Blackstone, and their $70 billion real estate investment trust, which has been I've been complaining about that trust since we started this show. I believe that all this corporate money in real estate is perverting the market. It's the reason prices are as elevated as they are. It's the reason that people overpaid like crazy during this last run-up. It's the reason that right now, first-time home buyers and people just getting started in this economy are shut out of it. Because these guys are spending other people's money, so if they pay a little more, they don't care. If they take a loss here or there, they don't care. It's not their money. And they're going to get their millions and millions in bonuses either way. right? But today, more interesting news on Blackstone. And I should have brought the paper to show you, but in the Las Vegas Review-Journal, big news, Blackstone selling their interest in the MGM and the Mandalay Bay. Now, these are two of the big, colossal resort casinos here in Vegas. And the way it works is Blackstone, these casinos in their genius, decided they needed to raise money and didn't want to go to the markets for it. So they sold their real estate portfolios to Blackstone, who then invited in our partner, Vici, or whatever they're called. And so Blackstone owns the real estate. So they own MGM, the building and the land it sits on. They own Mandalay Bay and the building it sits on, the land the building sits on. And the MGM Corporation, the casino company, leases these buildings back to Blackstone. Or leases these buildings from Blackstone. Well, now Blackstone, because of the redemption issue I talked about in yesterday's video, looks like they're moving to raise cash to save this real estate investment trust, which I'm going to talk about a little more next week because I don't know if they're going to be able to save it. But they sold out. They had in mind they sold out originally when Vici came in as a partner. Vici actually bought a 50.1% interest, leaving Blackstone with 49.9%. Blackstone just sold out the rest of the position to Vici, and they're out at MGM and Mandalay Bay. They valued the transaction at $5.5 billion. So I guess Blackstone's stake being roughly half of that, they're going to get $2.7 billion roughly for the share they own. I think part of that's going to be an assumption of some debt the company has. So Blackstone may not get all of that in cash, but nonetheless, just going on to show you the perilous state that real estate's in right now. These corporate guys, I think, might be fixing to get taught a little bit of a lesson by these markets. Recklessly investing, and I guess recklessly might be too strong of a word, but coming in and buying up entire neighborhoods and just buying blindly, not really paying above appraised value, creating a frenzy, which is now leading to this give back, which we're going to have. Maybe Blackstone's fixing to be sitting on some big losses. And I think that when you limit people getting their own money out of the fund, I got a feeling that next month Blackstone, they got hit with $1.8 billion, paid it out. Got hit with $3.3 billion this month, paid out 43%. I got a funny feeling. I can't wait to see if it gets reported or if I can find the numbers, because this real estate trust is not listed on any exchange. I think that they're going to probably get more than $3 billion in asks for redemptions in this month as investors start to panic and they see real estate's going down. They have a colossal portfolio of it. Their money's at risk, and now they can't get it out, or they can only get portions of it out. And what happens when the stampede, hits and everybody wants their money out at the same time? Now you're going to get 10% of your ask. So these companies, we're talking a $70 billion fund. The investors in this fund, they don't have, tens of thousands. They have tens of millions in this fund. And not being able to get access to their own money, I'm sure, is going to freak them out. Anyway, guys, just remember what's coming up here. We know we're going to wrap this week up on this. Expect more volatility in these markets as they digest news that's coming out piecemeal day by day. I think the Fed is going to stay strong in their rate increases. We're going to get this happen in December. We'll see how the C's look as we go into January, but I think they're going to stay strong till this inflation gets beat out. This week's rally, if you're feeling bullish, I'm not. I think it was kind of a mirage, and I think they took what they wanted from Powell's speech, rallied on that. Now it's going to be a give back. And the advice we've been giving you guys about your portfolios to stay in a defensive position get in and stay in a defensive position still stands. Like I said, you might give up some gains if the market really goes off, but you'll really protect yourself from some big butt losses if the market goes down, which in my humble opinion is way, way, way more likely. Anyway, guys, that's it for the week. We appreciate your support. As always, if you like what you're hearing, hit the like, ask your questions and comments, share the video with your friends, with your subscribers. We'll be back again next week to talk about, I'm guessing, a whole bunch more crazy as we move toward closing out this fourth calendar year quarter. Until we talk again on Monday, have a great weekend. And P.S. Bills get a big win last night. Go Bills, 9-3, baby. We'll see you guys on Monday. Till then, take care. Thanks.